Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes, and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. Today, we are digging deep into RateGain Travel Technologies Limited. Now, this is a company that, on the surface, looks like an absolute beast, a high-growth, high-profit machine.
It really does.
We're working from a pretty comprehensive equity research report here, and it paints a fascinating picture. On one hand, an incredible financial turnaround. On the other, some pretty jaw-dropping risks that we really need to get into.
That's right. And that's our mission for this deep dive. First, we need to understand what's going right. The macro tailwinds, this data moat they have that seems to justify such a high valuation.
And then the flip side.
We're going to put the red flags under the microscope. We're talking about a massive $250 million execution risk with a new acquisition and some structural governance concerns, including one number that, frankly, is just astonishing.
Okay, let's unpack this then. To really get RateGain, we have to start with the world they live in. So what makes this global travel technology SaaS market so hot right now? What are these tailwinds?
Well, the dynamics are incredibly strong. You're looking at a market that's projected to grow. The CAGR is estimated somewhere between 7.7% and 8.6%.
And that's all the way out to 2035.
Exactly. This isn't just some short-term bump. This is a long-term secular growth story.
So what's actually fueling that engine?
It's really a convergence of three big forces. First, and maybe most obviously, is the post-pandemic travel recovery. It's just back. International tourist arrivals are way up, especially in Asia-Pacific. They're on track to blow past pre-pandemic levels by 2026.
Okay, so more people traveling. That's one. The second is probably just digital transformation, which we see everywhere.
Precisely. Nearly 70% of all travel revenue now happens online. That shift is relentless. But the third driver is, I think, the most critical for what RateGain actually sells.
And that is?
The huge, persistent labor shortages hitting the hospitality sector all over the world.
Right. So hotels are basically being forced to automate just to keep the lights on.
You got it. These labor shortages are forcing them to adopt AI and automation for everything. Revenue management, forecasting, personalization. And this creates direct demand for RateGain's AI tools, making their tech less of a nice-to-have and more like essential plumbing for the business.
So if we connect that to the competitive landscape, travel tech is a brutal space. The report mentions high rivalry, high biopower from these massive hotel chains and OTAs. How does a company like RateGain not just get crushed?
This is maybe the most interesting part of the story. It's their moat. RateGain has carved out this unique strategic position because it offers solutions across three different areas: data as a service, or DASS, distribution, and MarTech.
And they argue no one else does all three at once.
That's their claim, yes.
Yeah.
They're not just selling one tool, they're selling an integrated toolkit. And all of it is powered by this incredible data infrastructure. The report calls it their data moat.
How big are we talking?
Immense. They're processing over 6 billion with a B price points every single year, pulled from more than 1,100 different sources.
6 billion. What does that actually let a hotel do?
It gives them almost perfect real-time intelligence on what their competitors are doing. In a world of dynamic pricing, that kind of data scale is everything. It lets them price their rooms with surgical precision to maximize what they earn.
And they're plugged into all the big players.
Oh, absolutely. 26 of the top 30 hotel chains, 25 of the top 30 OTAs. They're deeply woven into the fabric of this industry.
And looking at their business mix from FY24, MarTech is actually the biggest piece at 45%, and it's the fastest growing. But you're saying that data segment at about a third of the business is really the backbone here.
It is. The data and distribution parts give them that stable, high recurring revenue, over 97%, which Wall Street loves. So they have this solid base that lets them push into the higher growth MarTech side.
Okay, and this is where it gets really interesting for me. The market isn't just buying the model, it's reacting to this massive financial turnaround. They went from losing money just a few years ago to being wildly profitable. Can we put some numbers on that shift from FY21 to FY25?
The numbers are, frankly, spectacular. Operating revenue grew at a to-page year of 44% during that time, which is great. But the profitability,
yeah,
that's the real story. EBITDA grew at a staggering 140% to BJHR.
140%. So they didn't just get bigger, they got hyper efficient.
Completely flipped the profile.
Yeah.
The company went from a net margin of negative 11.2% in FY21 to posting a net profit of nearly 2,100 crores in FY25.
So the net margin expanded by, what is that, over 3,000 basis points?
A staggering 3,060 basis points.
That's incredible. Give us an analogy for that. What does that kind of shift feel like?
That's like going from struggling to pay your rent to buying the entire apartment building in just 4 years. It shows just massive operational leverage. You spread that fast-growing revenue over your largely fixed IT costs, and the profits just explode. It's the SaaS dream, really.
And the balance sheet looks great, too. Debt-free, lots of cash.
Exceptionally clean, yes. Their current ratio is up at 11.6, which is extremely liquid. But there is a small counterpoint here, even with all this good news.
Wait, if revenue is growing at 44% and profits at 140%, where's the catch? Why would the report flag anything about their capital efficiency?
Because context is everything. While the margins are fantastic, their returns on capital, well, they're just moderate, especially when you compare them to the absolute top-tier Indian SaaS companies.
Okay, so what are the numbers there?
Their return on capital employed, RCE, is at 17.3%, and return on equity is 13.3%. Good, but not elite. It lags the peer median. So they're very profitable, but they're not yet turning that incredible growth into, premium returns on the capital they're using. And that's sort of the first question mark.
So we have this high growth, high margin, debt-free leader that isn't quite at peak capital efficiency. This feels like the perfect bridge to the risk section, because that premium valuation they have must demand flawless execution.
It does. And this is where the report starts to flash some pretty critical red flags.
Let's start with their valuation and the quality of their cash flow.
Right. So they traded about 30 times EV to EBITDA. The peer median is closer to 25, so you're paying a premium. And for that premium, you expect perfection. But the first sign of trouble is in their cash conversion.
The consolidated free cash flow number looks strong on its own, but the key metric is that CFO to EBITDA ratio. Can you explain why that's so important?
Sure. The CFO EBITDA ratio is basically a reality check. It tells you how much of your reported operating profit, your EBITDA, is actually turning into cold, hard cash in your bank account. Ideally, you want to see that above 90%.
Yeah.
Analysts get worried when it consistently drops below 70%.
And what was RateGain's ratio in FY25?
It dropped sharply, all the way down to a very concerning 39.1%.
Wow, 39%. That's extremely low. So what does that mean in simple terms?
It means for every dollar of profit they reported on paper, they only actually collected 39 cents in cash. The other 61 cents are still floating out there somewhere.
So why is that? Why is the cash conversion so poor when the profits look so good?
The report points straight at one thing: exceptionally high days. Sales outstanding, or DSO. That's the average number of days it takes you to collect your money after you make a sale.
And theirs is high.
Very high. The consolidated DSO is over 70 days. But the standalone DSO is a shocking 108.8 days.
108 days. So on average, they're waiting almost 4 months to get paid on their domestic sales.
That's what the number says. It points to some pretty big collection challenges. And it suggests that revenue is being booked on the income statement, very aggressively, long before the cash actually comes in the door.
And the most alarming point on this whole cash flow issue is buried in those standalone figures. Standalone cash flow from operations was actually negative in FY25. Even though the standalone business reported a healthy net income, that kind of divergence is a huge flag.
It's the ultimate breakdown in cash conversion. It means the domestic business is reporting paper profits, but operationally, it's burning cash. It's a classic accounting red flag.
And now we get to the structural risk that helps explain this. The related party transactions, or RPTs. This might be the biggest shocker in the entire report.
This is, I would argue, the most critical structural risk facing the company. An RPT is just a deal between two parties that have a pre-existing relationship like a parent company and its subsidiary. They're legal, but they require a ton of scrutiny.
Okay, so what percentage of RateGain's domestic sales are RPTs?
The report flags an extremely high number. In FY25, 90.60% of standalone total sales were made to related parties.
90%. Let me just repeat that. Over 90% of their domestic sales are to their own related companies. Why is that such a massive governance concern?
Because it immediately raises questions about whether the pricing is fair. It's what's called arm's length pricing. When you're selling 90% of your services to your own entities, how does the market know you're charging them the same price you'd charge a normal external customer?
And this ties directly back to that terrible DSO number we just talked about.
Absolutely. If you're struggling to collect cash and your DSO is 108 days and almost all of those sales are to yourself, it makes you scrutinize the quality of those earnings very, very closely. It creates an inherent conflict that investors just hate to see.
And there were other governance issues too, right? Something about the auditor's report?
Yes, the auditor noted a critical deficiency in internal controls for FY25. Apparently, the audit trail feature on their accounting software wasn't even enabled. You add that to the RPTs and the fact that they've never paid a dividend, and you start to see layers of complexity here.
All of this really underscores that the premium valuation is fragile. It's sitting on top of some pretty significant risks.
The market is betting on perfection, despite these internal issues.
Okay, so let's look forward. The future story here is completely dominated by one thing: the massive $250 million acquisition of a company called Sojern.
This is their big strategic play. It's an all-cash deal designed to vault them into a leadership position in MarTech. The combined company is expected to generate over $310 million in revenue. It's a huge step up in scale.
So they're buying their future growth, essentially, but they're going from debt-free to taking on, well, a lot of risk to fund this $250 million bet.
And that's it. That is the single biggest vulnerability in the whole report: integration and execution risk. Any big M&A deal is tough. But when you spend this much, any failure to realize the synergies you promised is going to hammer that premium valuation. It has to be perfect.
So for anyone listening, what are the key things to watch to see if this bet is paying off? What are the KPIs?
I'd focus on three things. First, obviously, are the Sojern integration milestones. Are they hitting their targets? Are the synergies actually showing up? Second, you have to watch that consolidated CFO EBITDA conversion like a hawk. That number has to get back above 70% and stay there to prove the quality of the earnings.
And the third one is about the core business, right?
Yeah.
To make sure it's still healthy on its own.
Exactly. You have to track organic revenue growth. The company guided to a pretty moderate 6 to 8% for FY26. You need to see if the core platform is still growing on its own. If it's not, then the whole story just becomes about risky M&A.
So that really brings us to our synthesis. RateGain is a story of contrasts. You've got this high growth, high margin, debt-free leader with a real data moat.
No question. But that premium valuation is incredibly fragile. It's sitting on top of this massive execution risk with Sojern and, maybe more importantly, these unresolved governance issues. That 90.6% RPT number is a shadow that demonstrably impacts their cash flow quality.
It's the ultimate show me the money scenario, or rather, show me the cash.
It is. It looks fantastic on the income statement, but the cash flow statement tells a much more complicated story.
And that really leads us to our final thought.
Which is this: RateGain's entire future strategy now seems to hinge on large M&A deals for growth, and they've never returned cash to shareholders via a dividend. So you have to ask yourself, how long can the market tolerate this high capital retention, these complex governance issues, and this really inconsistent cash conversion before that premium valuation starts to crack?
Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time. Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes, and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. Today, we are digging deep into RateGain Travel Technologies Limited. Now, this is a company that, on the surface, looks like an absolute beast, a high-growth, high-profit machine.
It really does.
We're working from a pretty comprehensive equity research report here, and it paints a fascinating picture.